We had a new listing today, and in fact, Yash only spoke to the Joint Managing Director of Neogen Chemicals. Harin Kanani is the Joint Managing Director. It listed at a substantial premium on the bosses. Yash started off by asking him about the demand scenario. Let's listen in.
The Indian chemical industry has been there, like for example Neogen, which specializes in bromine and lithium based company, has been doing this since almost 1991. Throughout this 28-year journey, we've seen lots of ups and downs, economy opening up when the custom duty went from 150% to 15%, dot-com bubble, Lehman crisis, and through all, the chemical industry survived, and not only survived, is now thriving because of the innovation, because of the good chemistry which most of the Indian chemical industry has been doing, and majority of the people who are now significant players also have a very good compliance to the environmental laws, which was a disadvantage in the past, but now today the patience which we've kept has now proven. And as you can see that not only it's not just the environmental regulations which are being clamped down in China, but overall, the world has acknowledged the specialized skills we have in chemistry in India. And today they are coming to us with challenging projects, and we are very happy to be part of this journey of the Indian chemical industry. Even in Neogen, almost in spite of being relatively smaller as compared to our listed peers, almost 50% of our business comes internationally. And this is basically the sign of faith which the international community has on Indian chemical industry, which is what is taking us forward.
That's right, sir. And in fact, a few of the earnings of some of the specialty chemical makers which have come for the fourth quarter, they suggest that while the international market has not quite been robust, we have seen strong demand coming in from the domestic players. And I believe you also have a robust, customer base as far as the domestic business is concerned. How are you seeing the demand there, and do you expect the domestic growth to outpace that of the international business?
It's too early to tell, and I think we are seeing demand both from our domestic clients as well as international clients. You have to remember we are a B2B company, and we make this specialty bromine and lithium compounds for customers who are into API and agrochemical. So even these companies are seeing a good international demand, and what we see is because of this demand also their demand increasing, as well as international players wanting more favorable and additional sources within India. So both these are helping us in our growth.
I remember, sir, speaking to you at the time of the opening of your issue price, and you had mentioned how crude oil prices, they don't seem to have an effect as far as your EBITDA margin is concerned. But over the last 2 to 3 years, in fact, it has been largely stable around the 16.5 to 17.5%. And with crude not being a cause of concern for your company specifically, how do you see margins shaping up going forward?
So I think one of the big change in Neogen's journey came from, so we started in 1991, and a big change came for us when we acquired the site in Baroda in December 2016. Since then, our capacities have increased, and also our capacity utilizations are now slowly ramping up at the new Baroda site. So so in the first 6 months, as you know, were 53%, and as I also discussed earlier, that for the third quarter, it was almost upwards to 80%, which is the peak utilization. So as our utilizations improve, because of the capex that we have done for debottlenecking and improving the facility, this is what is helping us improve our margins, along with a better product mix. So as I mentioned with you, Neogen is also now focusing on more complicated chemistry, advanced intermediates. So a good mix of the advanced intermediates, custom and contract manufacturing, and better utilization is all driving our operating profits. So even going forward in the next financial year, since we'll have this high utilization for the whole year, we expect some improvements in our operating margins, as well as, you know, we expect also some of the interest costs to kind of come down, so also improve in our bottom line.